Right, let's go. It's Trade Zone on the 24th of May 2023, sponsored by 8Cap and presented by Track Record Trading Academy. My name is V, so let us begin. Today we're going to talk about the Reserve Bank of New Zealand's policy meeting earlier today, a few hours ago, and some that's uh, brief explanation of what the US debt ceiling is all about, and a trading tip to round up the trade zone for today. So, the RBNZ meeting, the Reserve Bank of New Zealand, hiked interest rates by a quarter of a percent as widely expected to 5.5% earlier today. But they shocked the markets by um, telling the markets that they expect policy interest rates to stay at 5.5% till June 2024, which is next year. What they mean is that this is the peak interest rates that they expect the markets to see, which means that they do not expect any interest rate hikes from here. And also, they shocked the markets further by projecting interest rate cuts from third quarter of next year. So this would be the first of the most hawkish central banks in the world to say in the developed markets to say that this is their final hike. They don't expect to hike anymore, and in fact, the next move is expected to be a cut, which is very shocking. And that we saw the markets react to it in that fashion. The FX markets, New Zealand dollar depreciated more than 1% in a matter of minutes against the US dollars as a result of this shock. This shock was especially jolting to the markets because in the previous meeting just last month, when the markets was expecting a hike of only 25 basis points, they did a 50 basis points instead. They did a 0.5% and cited inflationary fears. Although economy is slowing, it's not a problem for them, but they're more worried about inflation. So first they shocked the markets with a hawkish hike, and now they are shocking the markets with a dovish hike. So it's a bit of a whipsaw, right? So what we see on the short-term charts is that it broke a few support levels, which has now become resistance levels at close to 62 cents, and then just 61.80 around that level. We are seeing resistance now because market is trading below that. And for the support on the hourly charts, it's the previous low since early May. So we are seeing support at around 61.10 until these levels are broken. We are likely going to be trading with a bias to the downside because of this unexpectedly dovish policy decision from the RBNZ. The governor also said that he expects he now doesn't think that the tight labor market, the demand on the tight demand in the strong demand in the labor market is a problem, but he thinks now the problem is the lack of demand in the overall economy. So on the daily chart, moving on to the daily chart, zooming out, looking at the daily chart, we can see that it's clearly broken recent lows, and we are going to see it trade with a bearish bias, mainly going more to the downside over the next days and weeks ahead, unless we see more dovish news from the U.S. Federal Reserve, which will weaken the dollar a bit. But that is unlikely. And the next support level after the one at 61 cents is the one that we see the low from the last close to the lows from early March. So on the weekly chart, we are likely to see that we are seeing the same thing as well. But for now, I think if we break these two light green levels that we are drawing on the charts, you can draw it on your own charts as well. It's likely to see more downside open. And as you can see, we are using the Japanese Ichimoku chart. You will see that the price is strongly decisively below the Ichimoku cloud chart. That signifies a downtrend, And in the weekly as well, we're seeing it breaking into the region between of the cloud. So that's by theory, that's not likely to keep the price is not likely to stay within this zone for a long time. And given the fundamentals and the way that the market is caught, I think the markets, many of the speculators who were short before in April decided to turn long because of the hawkish reaction, hawkish hike from the unexpectedly bigger hike from the RBNZ. So we're likely to see more stop losses as London and New York wakes up to this shocking piece of news from the RBNZ. So on the bond yields front, we saw the 2-year bond yields in New Zealand fall by nearly 0.4% in a matter of 1 hour because of this unexpectedly dovish statement and also comments from the RBNZ governor. This is the biggest down move, 1-day down move in the New Zealand 2-year bond yield market since early 2000s. So I expect this to translate to even more weakness in the currencies as the day progresses. Why did the market react this way? This is a clear sign of a pause in interest rate hikes. And rate cuts are forecasted for next year, which is totally unexpected, because prior to this decision, the market was still pricing for more rate hikes in the months ahead. And this is, of course, the end of the hiking cycle. It's very weird for them to hike by more than expected in the previous month, and then this month you hike, and yet you say this is the end of the cycle, and you expect more pause ahead. It's a bit of a flip-flop, and it is a decision that was not unanimous. And in his press conference, Governor Orr said that it was a tough decision between hiking this meeting and pausing. So and they also forecast more negative growth for the GDP going forward. It is forecasted to be negative for Q3, the second quarter, as well as the third quarter of this year. Moving on to an issue that is now on the minds of many investors and speculators, the US debt ceiling that is now in the headlines almost every day. In fact, every day, because the US is running close to the end of their ability to keep borrowing from the market to pay their bills, because the debt ceiling has almost reached. They have a statutory debt limit which is enforced since 1917, so many years ago. But the ceiling has been repeatedly raised many times in the years since, because I guess if you start borrowing to spend, it's very hard to stop borrowing when the world is willing to lend you no matter how much money you owe, right? So in recent years, the debt ceiling has only been raised when it's very, very close to the deadline. The politicians are playing it for all they can to get their 15 minutes in the limelight, to appear like they are heroes when they're just doing what they're supposed to be doing all along. So it's much like handing in your homework just right before the clock runs down to 0 seconds, and then saying you're giving yourself a pat on the back when you knew all along it was due, like from years ago. How long ago, how important it is for you to hand in your homework before the deadline. So this is what the politicians do. That's what they've been doing, and now they are toying with the markets again, toying with the danger of actually flirting with a technical default, because they want to get the best deals for their own special interests. So from 2011 till now, they've been repeatedly running down the clock down to the last second before they get a debt agreement, get an agreement to raise the debt ceiling. So the current level of debt is a mind-boggling number of $31.4 trillion, right? But that just means they just have to keep raising the debt limit, because they cannot very well be paying down this debt anytime soon. So what will happen if the ceiling is not raised? The US government will run out of funds in early June, estimated by the US Treasury Secretary Yellen to be 1st of June, but the estimates vary across when you ask different people, but early June is inevitably the deadline for them to raise the debt limit if they are to avoid running out of money to pay their bills. So when they run out of cash, they will have to start defaulting on the bills coming due, and that would include bond payments, and that is what is increasing the fear and volatility in markets, as U.S. bonds are often thought to be risk-free because the U.S. government can always print dollars to repay its debt, and that's what they have always been doing. So imagine if your friends were lending you money, and all you had to do to pay them back and keep them from running out of patience is to write checks to promise them that you will pay them back someday. And of course, and you can print your own checks, you will keep doing this, right? There is no reason to start defaulting, because that will then that will wake them up to the fact that you really do not want to pay your debts. And so there is a possible global financial disruption on the horizon, given how large of a percentage the US dollar is in the foreign reserves of many countries, as well as how much the percentage it is in many pension funds and other investment funds as well. So that in the past we have seen the downgrade of the US bonds as we ran down close to the debt ceiling deadline. This was during the 2011 crisis of this nature, and as a result of that, the S&P downgraded U.S. bonds from the highest grade of AAA to double A plus, because they were flirting with the deadline, and it was not great optics. Back then, the other rating agencies of significance just changed their outlook. They did not really change the rating. S&P was the only one brave enough to say that the US debt is not AAA rated. So moving on to an analysis by an investment bank, JP Morgan, they project that the US will run out of cash by June 7th, so slightly later than the projections of the US Treasury Secretary, but they do expect that cash inflow from tax receipts from June 15 onwards will replenish the coffers. So as a result, any default will be technical in nature, because it's only a few days. They may just have to postpone the debt payments that are required. So it's only a temporary default, which is still bad for the markets, but it is not a default where the US will be unable to pay and refuse to pay for an extended period of time. However, it is still, if that should happen, it is still expect to be a market disruption, and that will cause extreme volatility in the asset markets. And as a result, we should be careful of that. And it is also one of the reasons why US stock markets performed badly yesterday, down after many days of being up. And despite the boom in AI and tech stocks, we are seeing some weak price action because of worries that the debt limit negotiations will not be completed before the deadline. For them to meet the deadline, the politicians President Biden and the Republican leader McCarthy will have to come to an agreement of a deal by the end of this week, because the deal will still need to go through the Congress and get signed by the president for it to be in effect before the cash runs out. Okay, moving on to a trading tip. As always, we like to round up the trade zone with a trading tip when we have time. We promised last week that we would talk about a structured trading process that will help you become successful over the longer run. And many will be confused as to what we mean by a structured trading process, and what it is important, because it ensures that you are trading for a legitimate reason, a sound reason, a reason that is well thought through, instead of trading on emotions or tips, or just chasing the market movements just because it's moving. And as a result, you will end up being more objective and less emotional. Hopefully, totally unemotional, but of course that is a hard a hard thing to achieve, especially at the beginning of your trading journey. It also helps you size your trades appropriately, because you will find you will be thinking through about the stop losses that you are willing, the stop amount, the capital that you're willing to risk on each of the trades that you're doing. So it also requires you to have it requires you to have a way to form a trading thesis, either by using technical analysis or fundamental analysis. And if you ask me, and I often get asked that, I say, why not use both, right? Why do you want to just use one part of the tool, only one tool that is available to you? Why not use both of the tools that are available to you to help you figure out what the current market conditions are and where it is likely to go in the days and weeks ahead? So it also requires you to have a process that helps you define the appropriate entry points for your trades, and the exit levels. And exit levels, I mean stop loss levels as well as target levels for your trade, so that you know ahead of time what you will do when things go wrong. And as I mentioned, the correct sizing of your trades is very important. What amateur traders tend to think is that when they make money, they're making too little, and when they lose money, and they're losing too much. And actually, most of the time, what ends up happening is they do exactly just that. They're losing too much because they don't have a stop loss, and they're making too little because they take profits too early, and they're getting in trades with very, very poor risk rewards. And over the longer run, they will end up losing all their capital in just a few trades when things go badly for them. The structured trading process is important, because you need the most important thing is to stick to the process, and that regardless of your short-term performance, you have to not deviate from the process. So one of the important things is to not deviate from the stops that you have objectively and unemotionally defined before you put the trade, unless of course your views changes and you want to exit early because things have changed. That is okay, but not move the stops away because it gets close. So there's a running joke among traders when we see traders that move stops away just because it's getting close. It's called the order that is cancel when close, right? So if for those of you who are very familiar with the way that orders are named, then you'll find it funny. Otherwise, you'll not know what I'm talking about. Anyway, however, moving stops to keep making room for a losing trade is extremely bad, because that means you're just unwilling to take the hit when you're wrong, and you're allocating your capital to an underperforming trade. So you just keep allocating more and more of your resources to a trade that keeps disappointing you. And obviously, objectively, if you think about that, eventually you'll spend too much of your capital on the trades that go wrong, and then allocate too little of your capital to the trades that go right. So, and always, you must always exit when you know that your view has failed, that market conditions have changed, the macroeconomic conditions have changed, the chart has changed, and the risk reward to the trade has changed. So there are always opportunities on the horizon. So do not be afraid of stopping out, because it is necessary when you're wrong. The trading process requires that you lose money when you're wrong and make money when you're right. So stopping out is necessary when the markets move against you, and you have to accept that as part of the trading journey, you will have to accept that traders are never always right. In fact, most of the time you are at best 50-50, and that is what most of the market trading legends have always said, right? If you ask them how often are they right, they will always tell you hardly ever more than 50%. But what they do well is that they stop out when they're wrong, and they run their winning trades when they are right. So always remember that there are more opportunities ahead, and you will never be you will never be running out of trading opportunities, because markets are always open, and it will always be there for the longest time. And what you need to do is to also be there and not get crushed and lose all your capital in a few trades. As always, thank you for being with us in Trade Zone. We end with this. The key to trading success is emotional discipline. And if you can control the downside, the upside will take care of itself. And this is why we say goodbye. And this is a reiteration of the need of a structured trading process that allows you to control your downside, and then the upside and the rewards will eventually flow in. Take care. As always, stay true to the process, and eventually you will build the habits that will lead you to success. Bye bye. See you next week.